Welcome back. Jigar Mistry of Buoyant Capital is here with us now to discuss the market fundamentals. Jigar, morning. Rima here. You've been a bit cautious about the markets for some time now, even in the last conversation. Have you, booked profits in any of the stocks, given that you're cautious? And if yes, do you want to tell us, some stocks that you like, but you think they've run their course?
Good morning, Rima. Thank you as always for inviting me to your show. So I think if we sort of start the discussion with the broad breakdown into, say, macro fundamentals and valuations, then we'll find that increasingly, things are not that hunky-dory as they appeared a few sort of months back, right? So clearly crude moving up, I think a lot of attention is still not being given to that format. And I think one needs to take into account that a $20 move essentially results in a very sort of large 30, 35 odd billion dollar sort of an hit. Compared to that, like the Morgan Stanley inclusion, sorry, the JP Morgan inclusion will only be a 24 billion per annum impact. Secondly, USD, very clearly the rates are here to stay for longer. And if you actually compare the repo Fed fund target rate differentials in an election year, then all of this is not, combining together to present a very happy picture. Now, you break the discussion down into, say, fundamentals, so you start realizing that where could the sort of growth in earnings come from, right? Accenture sort of put out the numbers yesterday, announcement that they put through. You realize that there's not a huge upside that's possible into this sector from an earnings standpoint. Oil and gas is decent, but then again, government windfall tax comes and takes a large part away. Crude, in fact, actually hurts FMCGs more than sort of it benefits the crude businesses. Capital goods, decent bookings, but essentially all back-ended. So besides the banking and financials part, you're not seeing a space where the earnings surprise could actually come from. Obviously, some small and mid caps are there for the taking, and there it does make sense. And lastly, on valuations, I think it has decidedly moved earlier. See, I think at the start of this month, we were discussing, and I said that earlier, the first leg of the cycle when valuations grows before the earnings catch on, and the second leg where the earnings catch up happen, that at the index level, it used to even out. Now that's happening that because India is possibly going to be into a great place in 10 years, all of that is transpiring into India being bought over across the board. Although FI's numbers, if you see, that's not really up there. So absolutely right. See, we were into almost 60% small and mid cap by March. We have sort of tapered that considerably, and we are sort of tapering that. We are getting into a lot more large caps. And taking time to get fully deployed. So sectorally, we did discuss last time banking financials. Now intermittently, it could provide great opportunities, right? If the US interest rates are going to be high, then essentially FIs will turn sellers, and of the 10 large overweight stocks, 6 are banks. So banks over the course of the next month or 2 months will provide great opportunities to get positioned. They're not cheap, but then they're not really as expensive as the rest of the market is. And secondly, I think there is a reasonable sort of opportunity in the pharma space as well. We had put out an article I think in April somewhere around, saying that whatever the 5-7 year destruction in sort of wealth that has happened in that sector may more or less be coming to an end, and we could again be on the sort of bandwagon for a great place to be in.
Okay, Jigar, that was a comprehensive summary across the sectors in the market as well. Since you are talking about some sectors that you like, pharma, for instance, or banking and financial services, I wanted your take on the chemical space. If you've looked at that, there have been a lot of updates. Quarter 1 was weak for the sector as a whole. Today, we have this big update coming in Naveen Fluorine. The stock is down 13%. If you can give your individual view on the stock and generally on the sector as well, because they did talk about some recovery coming in the second half. Do you think this could be the right time to look at the sector?
Yeah, good morning, Sonal. So yeah, see, essentially it's a space where things, are earlier the whole thesis was China plus one, right? And you talk to most chemical names, they essentially say there is no plus one, there is only China. Correct. So I think increasingly that's what the sort of feeling we were getting. the price at which China was offering material, even there were cuts in transit at times. You book the cargo before it reaches, there were price cuts. So in that scenario, the size is not maintainable. And I think as investors, we went a little bit overboard as well. Anything that would sell, we would start classifying as specialty chemicals, and that essentially, got a lot of valuations, but then not really the pricing power that should come along with specialty valuations. I think now that's sort of evened out a little bit, and our interactions with the chemical companies suggest that things are not really improving it at the margin as much as they have sort of stopped falling, right? It was, say, where pharma was last year when, the generic prices were not falling at the same pace, and we tried taking that as a positive. I think we are sort of in a similar space. So we are not really looking to build in very large positions here. But yeah, maybe the worst is behind and it's not worsening at the same speed it used to be.
Which segments do you think are likely to see EPS upgrades in the upcoming earnings season? And is tech going to see downgrades?
I think so, Rima. See, tech, clearly there has been still a lot of hope that's being built out. And commentary after commentary, we are not seeing sort of the growth in revenues that everybody has built in at the time when margin picture is not really all that great. Right. So very clearly, we are not really seeing tech in a runaway rally soon. And I think the disconnect is that a lot of people are saying that they are a lot more inexpensive now. But my submission is slightly different, that India doesn't really have tech, right? We have IT services. The cash flow is very different, say, from a Zoom, where revenue can double or triple in any given year. So whereas a high valuation multiple post-COVID to such a business is warranted, for IT services, pre-COVID, I remember all companies were talking a double-digit growth for the forward guidance. Today, virtually nobody is talking a double-digit growth. Correct. So valuations put in perspective is not really all that great. And we are sort of, because everything else is so expensive, we are trying to hope against hope and say that things could turn around very well. And that really isn't, being very apparent in terms of where the actual industry is heading. So EPS upgrades, I think the only place, if say crude doesn't correct, then I think otherwise FMCG volumes, we were very hopeful. But with crude coming in, at least it won't impact this quarter because of the inventory cycle. But it's not a pretty picture. So other than banks and some select businesses which are reacting to their own cycles rather than sector level exposures, I think they could report it. But at the index level, if you are looking at it, I would go into the assumption that you are seeing cuts rather than upgrades at the end of it.
Okay, all right, Jigar, thank you so much for joining us today with your take on the markets and sector-specific action as well. Always a pleasure speaking with you. With that, we'll slip into a break. More news and updates will follow on the other side. Stay tuned.